Very good afternoon, ladies and gentlemen. It's a privilege to be here. I must say that I really enjoyed almost 2 hours that we spent with the members of CII, having some very interesting discussions. I learned a lot. Hopefully I shared the SEBI perspective on how we think, and that's, I think, most important, that what is the regulatory intent in everything that we do. And today's summit on building trust, I think, could not have been more appropriate. To our mind, the entire edifice of not just the market, but the entire economy rests on the edifice of trust. And to us, and as I said earlier in the morning, for trust, it's a two-way street. It takes two to tango. So not only is it imperative for the industry to create trust and build trust, it is also equally imperative for the regulator to build trust in itself. Why is this? Because the regulator in many ways is simply a proxy for the wider investor base. And as we discussed earlier this morning, when a private equity investor invests in a private company, there is a certain relationship of trust between them. And there are certain roles and responsibilities that are played out in that relationship. When a company goes public, the regulator steps in as a proxy for the larger investors. Today, overall, across the market, 44% of shareholding is with the promoters, 56% is with the public. So the regulator is nothing but a proxy for that 56%. And so when industry seeks to build trust with the regulator, it's trying to build trust with the market. And when the regulator seeks to build trust with industry, it is doing so only as a representative of that 56%. To us as a regulator, the most fundamental attribute of trust is transparency. And I'm delighted at the way in which today's program is going to go forward. But somebody once told me that the problem with people who see a lot of opportunity ahead of them is that they sometimes forget to look back and see how far they've come. So I thought, first let me start with a quick look at how far we have come. And truly, it is something that we're all so proud of. I like to refer to it as momentum, right? Momentum of the Indian economy, momentum of the Indian markets, momentum of the Indian businesses. And this Indian momentum has its own unique characteristics. I can't help but refer to, and all of us studied this in physics, right? So Newtonian mechanics tells us that momentum is equal to mass into velocity. India has always had the mass because it's had this huge scale, this huge size, the demographic dividend. We've always had it. But what is it that is giving us momentum today is the velocity. What is the manifestation of this velocity? Whenever I meet overseas investors, and I meet many of them today because many of them are coming into India because they either want to start investing in India or increase their allocations to India. And at the same time, we have an outreach program. We go and meet a large number of foreign investors to tell them and talk to them about India and its market. And what I share with them are my thoughts, two very simple thoughts about velocity. I'm not an economist, so I'm very happy to plead ignorance that I don't understand complex econometric models. To me, I track only two sets of parameters. The first are tax collections. Because as they say, there are only two realities in life, taxes and death. So we won't talk about death, we can talk about taxes. There is no assumption in tax collection numbers. There are no models. This is a reality, you can trust it. So you look at the GST collections, and it's been an amazing story for the country. Yes, initially it was about greater compliance. After that, yes, there was a certain element of inflation. But at the end of the day, there is the growth there. And what started as over there, 1 lakh crores per month is today at 1.68. This is not trivial. And the global investors, when they see this chart, they actually find that it's illuminating, that, oh, we didn't realize it was this good. Look at the advanced tax. And again, I talked to them about how in India we have a concept of advanced tax, which is nothing but a forward-looking statement by the economy as a whole as to how much profit is going to be made in the system. So you look at the numbers quarter on quarter, 14% up in, this is cumulative, quarter on quarter. So 14%, 21%, and Q3 up 20% from last year. This is the velocity of India. This is what is giving us momentum. Now, being somewhat of a realist, I also like to look at the real economy, just not the financial numbers. And what is my favorite proxy for looking at that is power consumption. Look at the trend again, whether it is petrol product consumption or electricity supply. Of course, there is a cyclicality to all of this, but look at the trend line and the way it is growing. The only area where we see much more volatility is in natural gas, but that's largely because of, global issues and geopolitical issues. But the key productive activity in the economy, you can look at the trend line there, and again, you see the velocity at which the country is moving. How is this manifested in the market? And it's really amazing to see. We talk about hockey stick phenomena at an enterprise level. What we are witnessing is the hockey stick phenomena at an economy level, at a market-wide level, at an ecosystem level. So if you see the way the market cap has gone, right, from 74 lakh crores to 378 lakh crores, we are at one-time GDP now. The growth has been phenomenal in just 10 years. You look at India's weight in the emerging market index. We started at 6.6, we are today at 17.6. It's just, again, and look at that hockey stick effect. So this is the velocity that we speak about. This is the momentum of India, the new India. This is a favorite slide also that I like to show. Why is it that our markets are commanding? And this is, I think, an achievement for each person in this room, because you are the ones who are commanding this price to earning multiple, which is higher than not only the averages of the world indices, but you can see there the comparison with various nations. So at 22.2, yes, some people say we are an expensive market, but still, why is the investment coming? Because this is a reflection of the optimism and the trust and faith that the world has in India today, that we are commanding these kind of multiples in our markets. The other thing which is driving, of course, the resilience of our markets is the participation of retail investors, both directly and indirectly through the mutual funds. Look at the velocity over a 10-year period. The blue line going from 1 crore investors, unique investors. These are unique PANs deduplicated across mutual funds. 1 crore to 4.4 crore. Look at the asset under management, the orange line, going from 8 lakh crores to 55 lakh crores. This is the velocity of India and India's markets. All of this, to what intent, to what purpose? At SEBI, we have often said that the sole reason for SEBI's existence is capital formation. Everything else is incidental. If we don't facilitate capital formation, we will not have fulfilled our basic purpose of existence. So if you look at fund mobilization, and we're just comparing the last 12 months with the corresponding previous 12 months, and I'm sure these numbers will surprise some of you. While the equity numbers are good and up 19%, look at the debt numbers. It is huge. You know, this is the often forgotten child of the Indian markets. We're so focused on the equity markets, we sometimes forget what is it that the bond market is doing for the Indian economy. So when we add the two together, 10.5 lakh crores has been raised by industry from the capital market in the past 12 months. This is not trivial. This is velocity. REITs and InvITs, I've said on numerous occasions that we see this as the vehicle of future growth. And we think that going forward, possibly REITs, InvITs, and Muni bonds together can be in value equal to our entire market the way it is valued today. In other words, one-time GDP. So to us, this growth, and you can see there, is again a symptom of early signs. So while the numbers are small, about 6,000 crores and 22,000 crores, the numbers are small, but look at the velocity, look at the speed at which it is picking up, and we would like to see this growing in, as many ways and forms as possible. A quick look again at the bond numbers, because as I said, this is often a forgotten child. So the numbers speak. What this number shows is, for every 100 rupees that the banking system gives to corporate India, how many rupees does the bond market give? Now this number peaked post-COVID because a lot of the money that came in through the low-cost funds that the Reserve Bank released. And today we're stabilizing at about that number of 56%. If we add the commercial paper to it, this number would actually again pop back up and cross 60%, because that's another 4 lakh crores roughly. So about 62% is again what we would say. So in short, the fixed income market is giving 60 rupees to industry for every 100 rupees that the banking system gives to industry. This is not trivial, this is significant, and it is growing. So how does all of this work from our perspective as a regulator? We are committed to the entire process of co-creation. We have in SEBI a very, very rich tradition for the last 30 years of having very strong advisory committees who guide us on formulation of policy. What we have done in the recent past, and was referred by Sanjeev and Dinesh, was we've taken it to the next level, which is what? We find that large parts of industry never have a problem with our regulatory objective. The destination is never a problem. They agree that something needs to be done here, something needs to be done there. It's just that the path that we end up prescribing is very painful. Now, what we therefore said was, why should we allow that to happen? It is not our intent to make the path painful. It is our intent to make the path as easy as possible to get to that destination which we both share. So we have extended the concept of co-creation to this concept of industry standards forum, and as has been pointed out, the results have been sparkling. The kind of inputs that we are getting, the kind of discussions we have in this forum, in order to ease out the effort for compliance, and as I said in our meeting earlier this morning, was that it is our intent and our hope that the industry works to actually pick up line item by line item of SEBI regulations and circulars and define the standards which will be deemed to be in compliance. And therefore, to make compliance so painless that it's like breathing. A company just runs and focuses on its customers and on its business, and compliance just happens because it's so clear, so simple, and so easy to implement. That is our objective. In all of this, we think that technology as an enabler has a huge role to play, because this is the one tool which we know which reduces risk, reduces cost, and improves and optimizes whatever we are trying to achieve, whether compliance or whether customer benefit, etc. Now, our T+1, which was itself a global first, because there was no large market in the world which had achieved T+1, was implemented, with the support of the entire ecosystem. And interestingly, we measure something called the defect rate of settlement by something which is a measure of what is your DVP ratio, delivery versus payment ratio. Prior to moving to T+1, the defect rate was about 0.7, 0.8%. After implementation of T+1, it actually halved to 0.3 to 0.4%. So actually, the entire process was far more optimal and efficient after moving to T+1. And of course, now we have moved into optional T+0. And what I think gives us huge satisfaction is the fact that there was one person who said to me, I don't know if Vikram Kothari is here today, He said to me one day that there was a time when we as Indians used to sit in the last seat of global fora, the last row. Today, we sit in center stage. We have, I had dozens of pictures to choose from, but whether it is NSE, BSE, NSDL, CDSL, the number of awards that have been won, this is my favorite, Nehal, the number of awards that have been won by our market infrastructure institutions, whether it is for T+1, T+0, for distributed ledger technology. I don't know how many of you know, we've implemented one of the most sophisticated distributed ledger technologies for our bond market, for which NSDL has been feted across the globe. So today we are at center stage. People turn to India and ask us for guidance, for advice. We sit there as panelists on discussions. We are not sitting on the last row. We are sitting in center stage, receiving awards and giving guidance to the rest of the world on how we have implemented cutting-edge technology and cutting-edge regulation. In doing all of this, as I said, how do we think about SEBI itself? And to us, the question of trust is not a question of finger pointing. It's a question of both sides need to earn trust. You need to earn your stripes. So as SEBI also, we need to earn the trust of industry. And what are we doing towards that? I already shared the thought about co-creation. It's also about transparency. Because just as we ask industry for transparency, we believe we should be transparent as well. As many of you know, we have a three-pronged mandate. In the preamble of the SEBI Act, we are mandated to facilitate development of the market, regulation of the market, and investor protection. Three things. So we have started measuring, and we have started going public with these numbers to say that today, if you look at the last, this is updated till February. So for this financial year, based on all the circulars that we've issued, about 50% are regulatory in nature, which means investor protection and risk reduction. The balance, 44%, a large part, is developmental and ease of doing business, ease of compliance. And our definition of developmental is very tight. We have to facilitate a new product, a new asset class, a new channel, a new investor class, something new which is being encouraged. We were referring to the small and medium REITs. We've talked about online bond platforms. We've talked about the repo institution. So many things are really sitting there in developmental. So today, our balance sheet is very, very balanced. In fact, I worry that, will we really have the ability to hold this ratio? It is our desire. But at the same time, the most important thing is whether we succeed or not, the important thing is to be transparent and share with you that actually, contrary to popular belief that regulators only always tightening things, it is factually not true. 44% of the time, we are doing ease of doing business and development. It's just that since it's non-controversial, it rarely grabs the headlines. Now, the question is, secondly, about the inner workings of SEBI. So we are committed to efficiency because, as I said, trust has to be earned by us as well. So what is most important is capital formation, and these are the two internal processes which fuel the capital formation. So public issuance approvals, as you can see, we've started tracking quarter on quarter the numbers as to where we stand internally. Having pendency is actually a good thing because it means there's more activity in the market. But aging is a bad thing. So as you can see, so long as something is in the green and yellow, we consider it good. The minute it goes into blue and gray, the teams are answerable as to why that is pending, what is it that is obstructing it, and what are the policy interventions we have to take in order to eliminate those, that aging. Now, the important thing, I've said this once before, it's worth repeating. Normally, in any government organization, the time or the clock starts. Pendency or aging is usually measured from the time of receipt of all information. Now, as you can imagine, that's a huge loophole in favor of every government official, because the moment he's running out of time, he simply has to ask one more question and his clock gets reset, right? Now, we don't allow that in SEBI anymore from an internal MIS perspective. Legally, that's still the case, and that continues because we are a part of the government. But internally, for performance management, this entire aging analysis is from the date of first application. So there are no excuses here, there's no loophole here, there is no escape for the SEBI official to simply ask one more question and say, oh, I'm in time. So this is really important for us, and this is our commitment, and this is our transparency. There may be days and times when we don't do well on this, but then we are answerable to the industry as to what we are doing to correct it. Mutual fund schemes, I think we have some mutual fund colleagues here. I'm told in lighter vein that earlier it used to be the case that the sales guys used to tell the compliance guys that file the documents with SEBI. Now they'll take 3-4 months to clear it by the time, you file the paper, file the paper. And these days, the sales guys tell the compliance guys, don't file the paper. SEBI will approve it in 3 days, 4 days. I'm not ready for launch. So that is the speed that we aspire to, and we are streamlining our use of technology, our processes, our focus of the teams in order to make sure that wherever there is an opportunity to raise capital from the market, there is never any reason for any delay from SEBI end. So in short, the entire question of trust, this two-way trust, as I like to call it, it takes two to tango. We need to do this together. Otherwise, it will not work. And what we are hoping for is that this wonderful momentum that we have in our country today, it's an amazing velocity that we have already taken, right? How do we take this velocity further? And thanks to Newton, let's make sure that our P is equal to MV remains our mantra, and that the velocity goes faster and faster. And next, we look at acceleration and not just velocity. Thank you.